Today, we're always cautious to say 1 month and 1 quarter is not what we're focused on. But the flow environment right now is quite good. A lot of interest in all of our different product areas, so that's a good thing. You mentioned the 3-year tranche earlier. To us, the most important thing about the 3-year tranche has been the exceedingly high percentage of investors who, once that 3-year tranche has expired, have stayed with the firm, either by extending the 3-year tranche or rolling into a different tranche. That's been very important. So the flow environment today looks good, and now we just have to execute. For that 2 to 3 year period I'm talking about, there was something out there. In most cases, it was the European banking system or the situation. There was something out there that concerned people about contagion risk in the world. And right now, as you see from credit spreads and markets, that's not the first things on people's minds. Having said that, very interesting, someone pointed out to me recently about how low risk things are. Just look at implied volatilities if you want to know how low risk things are. And I thought, wow, the last time I heard that was 2007. So, one of the things that we're fond of saying our firm, remember 2007, if you use models to make your decisions and run your risk, the better your models were and the smarter your PhDs were, the more you presume that low volatility and low trending volatility, and probably the third and fourth derivative of trending volatility, implied lower future volatility. And all we said at that time, which we'll say again today, no one is going to call us up the day before volatility implodes and tell us it's going to implode. We're certain of that. So that's why we have to run our portfolios all day, every day to protect clients. But to answer your specific question, right now the #1 topic is not, hey, what about this type of contagion risk? It's about where do you see opportunity? Look, fixed income yields 3-ish%. If you need 7.5%, whether you're a pension fund or other institutional investor, you can do the arithmetic. If you get 3-ish% and you need 7.5%, unless you think you're going to get capital appreciation, all you know is that you're falling behind your bogey every day, including Saturdays, Sundays, and holidays. Equities, I think that, look, people are comfortable right now, but investors also know that historically it's been very difficult to recover from any type of drawdown. And that opportunistically, investors are looking in today's, equity markets are up and credit spreads are tight. Where can we generate return that's differentiated? And we think we're well positioned for all three. Don't forget, every private bank, so 14% of our assets come from private banks with an underlying. And the key is we're not going to do it by marketing or advertising. We're going to do it by continuing to make the brand better and better and better, and that's our focus. I will make a couple of comments about the Cinda transaction because I think it demonstrates a lot of the edge that we've created for our clients through all the things that we do. Cinda, we believe, is going to be an extremely attractive transaction, and OCSIF is the largest cornerstone investor. Cinda is a company, for those who don't know, it's the largest independent purchaser of non-performing loans in China, which we think is going to be a growing market. They are going public on the Hong Kong Exchange to grow the business. As the largest cornerstone investor, we're well positioned to help participate in that growth. But how do we get that? I think, and the IPO price is actually starts trading tomorrow, Thursday in Hong Kong. For now, you've read the press reports. It's a very oversubscribed IPO. The question is, well, how do we get that? We've been in Asia for almost 15 years. We have an office in Beijing. If you remember when China announced 6 funds that were going to be able to participate in their QDLP program, we were one of them. It's about you build a brand. You're the best product. You have a reputation where you're the firm they want to deal with. Those are the reasons that we're able to establish that position. So it's about size, resources, reputation, relationships. We think that there will be more opportunities like that. Some might be announced things such as a Cinda. Some may be things that you don't actually read about. Some of them may be in emerging markets. Some of them may be in developed markets, probably both. But that's one of the real differentiated edges. And those are the types of things when we sit down with clients today. Interesting. We see a shift in the dynamic. There's a big shift in the dynamic from the standard question, what about size? Isn't size going to be a problem? Then we saw the shift where they saw the numbers and the nimbleness and said, wait a second, size isn't a problem at all. It seems to be working. Now they're starting to get why we're using our size to create advantages. We talked about our real estate products and our real estate capabilities, and then we talked about our structured credit capabilities. Now we're talking about the whole space that exists between credit and real estate that's changing and shifting. Being as well positioned as we are is really important and really differentiating. And we see that size doesn't create the advantage if you sit there. Size gives the ability to create the advantage if you think ahead, invest, work, and have the one-team structure we have that gets everyone working together. Well, our investors and our LPs clearly understand the consistency and repeatability of our performance. Since the firm's gone public, we've obviously been in the most volatile environment of the past 20 years. But we've always felt that the right way to look at the valuation of our firm is, as my partner Joel Frank says, it's a very simple financial model. Management fees, which are a fixed percentage of assets under management, versus that we have non-comp and expenses and salaries and benefits. And then if we perform, we generate an incentive allocation, which in almost all cases is 20% of the performance. In almost all cases, and this is very different from a lot of the other alternative managers, virtually all of that 20%, the vast majority of that 20% gets paid to us in cash each year. And it gets paid out as a dividend each year. So one of our goals as a public company was to show public shareholders that our consistency warranted a multiple on incentive allocation that was correlated to the consistency of it. We think we're in the process of doing that. We think the way to do that, as we've discussed, is time. Just showing year after year that we can do it. Year's not over yet, but we feel good about how we're doing. If we do that, and then we grow our other products, that gives the firm a more diversified asset, fee stream, and incentive base, we think that there's room for multiple expansion. Well, in terms of investment opportunities, the two most robust areas for us are event-driven equities globally, which is the largest allocation in the multi-strategy funds, and structured credit in the U.S. and Europe. That's both buying legacy assets as well as some of the newer things that we've spoken about. In terms of tapering, I think it's very important, and clients really rely on us for this, because I think our risk management and allocating of assets work well through these cycles. Everyone talks about tapering and when's it going to happen, what's it going to be, and how are things going to react. And I always like to remind people that this is an environment where even if you had tomorrow's newspaper, I'm not sure you would necessarily know the right decisions to make. I mean, let's talk about what happened in 2013 with tapering. In roughly April or May, certain officials of the Fed started talking about the word tapering, and then they mentioned it multiple times in a way that the markets took to mean they're going to taper in September. But if I'd had the newspaper that said, here's what's going to happen, they're going to talk about tapering in April, May, everyone's going to expect them to do it in September, and then they'll do nothing. Okay, so what's going to happen? Well, I don't know if you would have said, well, bond rates, 10-year rates going to go up over 100 basis points. Not sure you would have said India and Indonesian equity markets might suffer the most from it, and other emerging markets. And I'm not sure you would have said, and by the way, equities will see right through it. So, we often say our job is not to predict. Our job is to anticipate, understand where the risks and opportunities are, and adapt. And that's what we're going to continue to do, and that's what clients rely on us for.